Welcome to Under One Roof MTL, where we are demystifying home ownership one episode at a time. My name is Robin Flynn, joined as always by Fred Pichette and Martin Spalding of Fred and Martin Mortgages. Good afternoon, gentlemen.
Happy Sunday, Robin.
Happy Sunday. So much going on in the news, but before we get to that, we do want to get to our trivia question of the week, brought to you by Felix and Norton Cookies. You can visit their store at the Blue Haven Shopping Center, 3705 St. John's Boulevard in DDO. The first person to text in the correct response to our question will receive cookies from Felix and Norton delivered straight to their door. You don't even have to leave your house. 514-790-0800 if you think you know it, and please do include your name. Our question this week, bit of a softball. The last few have been a little tricky, so this one's a bit of an easy one. What is the difference between a variable rate mortgage and a fixed rate mortgage? If you listen to this show every week, you should know the answer to that question.
It's the great debate these days.
Yeah, exactly. Which one should you choose? But you need to know what the difference is. If you think you do know it, 514-790-0800. Martin, you sent us this article this week, which is a little concerning, more than a little concerning. Apparently, 9 in 10 Canadians are concerned about the state of housing in Canada today. That's a lot of Canadians. That is a significant majority of Canadians. So why are so many of us worried about housing right now?
Well, it just seems like when I saw this article, I said, most people have a dream of owning their own home. And when you see the headline of this article, you go, is that dream still attainable, accessible? So, why are many Canadians concerned about housing right now? Well, because affordability, accessibility, a lot of them have reached a breaking point. Home prices and rents have gone through the roof, and the housing supply is still not at the level that we need it to be. And also, a lot of the construction that's taken place in the last few years is not the right type of housing that we need currently. Many people feel that the system no longer works for them. Even the middle class, and we work with a lot of people, Fred and I, even the middle class are struggling to qualify. And a lot of renters are actually being priced out of the market. So I'll give you a couple stories. So I got into an Uber this week because I had to go to an appointment. And here's a guy that in 2 years has already driven his car 200,000 kilometers. He has transported, he told me because I was curious, he's transported 8,000 clients and he can barely pay his rent and his miscellaneous monthly expenses. So, in his eyes, the dream of owning a home is no longer a reality. On the other hand, Fred and I are currently working with a young couple. He's got 2 jobs, she's got 3 jobs, and they're raising a young family. And for them, the most important thing is to get into their first home. So they're doing absolutely everything in their power to get there. But having to work 2 and 3 jobs in Canada today is not what the dream was supposed to be about.
Yeah, and you're going to need a lot of luck when you're working two, three jobs and just pray that nobody gets sick or injured, or because that's a huge strain on you. Even if you're young and healthy, working that many jobs and that many hours in a week, that's stressful.
Well, this Uber driver told me he's driving anywhere between 75 and 90 hours a week. He'll drive until he drops. He'll sleep 3 hours, so he'll pull himself out of the system for 3 hours, sleep in his car, and then when he wakes up, grabs a cup of coffee, logs back in, and starts driving all over again. And a guy who's working 75 to 100 hours a week should be able to afford a home. And there was another news article that came out this week. It was on the CBC where they're talking about 120,000 families are likely to leave the greater Montreal area to move into the country where affordability is a lot more reasonable. So, what is that going to do to the tax base of Montreal if families continue to migrate up north or to the eastern townships? It's going to kill Montreal and it's just going to drive property values up. Tax base will be driven up as well. So, it's almost like a perfect storm. And so we come back, we've talked about it a while ago. There are these strawberry box houses, and they're all over Côte Saint Luc, they're all over NDG, they're all over Lachine. We need to get, whether it's prefab houses or strawberry box houses, we need single family dwellings, or we need to change the zoning where you're only allowed to build a single family dwelling. You should be allowed to build a duplex, a triplex, or a fourplex.
Well, did you
We need to
see
get busy.
Mark Carney's Liberals unveiled their catalog of what are the modern strawberry box houses that they're planning to build. I was looking at them this week because they're all these cute little modern tiny homes basically. They're so cute. Fred, how do you feel about this? Like who is most impacted by this right now?
Well, I think the most impacted are the younger Canadian and the family with young children. Obviously, my son is 22 years old and he keeps saying me, Daddy, I don't want to go live in, sorry, past Saint Jerome so far like that. I want to live in Montreal or in the suburb of Montreal. And it's, as Martin says, I think rules has to potentially change a little bit for first time home buyers. If you remember a year and a half ago, they extend the amortization period for first time home buyer up to 30 years when before it was up to 25 years. Now maybe they should potentially extend it to 35 years to help them out, you know? Like there's a couple measure that has to be taken if the new generation or the young generation wants to take ownership. Yeah.
Yeah, especially the down payment. If your parents aren't able to help you out with a down payment, that is so difficult to save up. Like if you are somebody who's making like an entry level salary out of college, which is right now sadly 45, $50,000 would be considered a good job for someone out of college, and you're spending, $2,000 a month on rent. Yeah, it's possible to save money, but nothing better ever go wrong in your life. You better not have student loans, you better not have a wedding you have to attend. It's really difficult to save up 5% of $500,000, right?
Well,
Well, what do you get for $500,000 in Montreal today?
Not
Yeah,
very
most of the towers where, our offices that we work right across the street from the Bell Center, and all of Griffintown and all those towers around the Bell Center, it starts at 1,000 a square foot, 1,200 a square foot. So to buy a 500 square foot apartment, you're in the five, six, 700,000. That's just crazy. Plus condo fees, plus municipal and school taxes. It's just not affordable. So I agree with Fred. A lot of people don't want to go from, "Hey, I'm a downtown kid. I lived in the McGill ghetto when I went to McGill. And now I got to live in Saint Jerome because that's all I can afford." Living in Saint Jerome and you've got a job downtown, how's that going to work out for you?
Yeah, have fun commuting on the Laurentian Outer route, which is still under construction. Took me like 2 hours to get up to the Morin Heights area last weekend to visit my grandmother for Thanksgiving.
When is it not under construction?
And when is anything not under construction in this area? Okay, before
I think the whole city is under construction as well, not only the highway.
Yeah, when is Montreal gonna be finished? When are they gonna be done? So, in addition to seeing that people are so worried about housing, is there any hope that we can give them? Possible solutions? Martin, you mentioned those strawberry box houses. Mark Carney's Liberals did release a catalog of these homes that they're gonna build. I'd like to see how and when these actual homes are gonna be built and how much they'll cost. But what are some solutions here?
Well, as simple as this may sound, we just need to build more homes faster and the right types of homes. So we need to cut the red tape, speed up the building approvals. We need to relax the zoning. So allow more duplexes, triplexes, multiplexes in single family dwelling zones. We talked about strawberry box homes. We need to increase infrastructure funding. There are a lot of communities, a lot of people are moving up to Saint Sever and they're moving up to Morin Heights. Well, the infrastructure can't keep up with all the building. So now some of those communities have put a pause on giving building, what do they call, building licenses or building
Permit.
permits because the infrastructure in the sewers and the water is just not keeping up with the demand. We also got to address the empty tower syndrome. Foreign buyers who are buying to park their money in a safe country like Canada. We need to offer tax credit and low interest financing for developers who want to build affordable and green housing. We just everything that, these are all seem like simple steps, but we just got to get on with it. Sorry, Fred.
And I would say, Martin, maybe that you should revisit the mortgage qualification rules in place, like the stress test for potentially new first-time home buyers. Is it really something that we need, or we have to ease the qualification? That's for sure.
Well, we're going to talk about the stress test a little bit later.
Yeah.
But for a lot of people who signed during COVID at 1.75 and now are being confronted by uh, or renewals in the fours, good thing the stress test was there.
Also, how much you pay in rent every month should be counted. Like, I've heard of friends who had their down payment and the bank told them, no, you don't qualify for a $1,400 a month mortgage. Meanwhile, they're paying $2,200 a month in rent. Like, well, I've never missed a rent payment. So that should be counted when they're considering and qualifying you as well. Martin, you mentioned multiplexes. If you do already own a multiplex and you'd like to outsource your property management, you can contact the Plex Doctor. Call them at 514-709-6397 or visit their website at plexdr.com. Still to come, we received so many questions this week that we decided to basically dedicate an entire segment to answering your questions. That's coming up after we check traffic. I'm Robin. That's Fred. That is Martin. We're answering your questions. If you have any questions for the gentleman, 514-790-0800. First question, guys. What's the difference between getting a mortgage from a bank versus a mortgage broker? I think a lot of people don't know what a mortgage broker does. They assume if I need to buy a house, I should just go directly to whatever bank my checking account is with and apply directly there. Why would that possibly be a mistake, Fred?
Well, first of all, as a mortgage broker, we're not linked to any banks or lenders. We're representing our client. That's number one. Number two, we also have access to different, like many different lenders, all type of lenders, like we call A lenders, any regular bank. We have monoline lenders like First National, MCAT, Eric's. We also have access to alternative lenders that we have a multiple choice for our client. And the fact that as a certified mortgage broker, I know how it works. We know how it works. Like Martin and I, we guide our client through the whole process, which is that's important versus if you go directly to your bank, which is you're allowed to. It's maybe you getting one opinion, one option only. Like that's why probably working with a mortgage broker, it's better for you.
Martin, I think a common misconception is that mortgage brokers have a fee, but for the client, working with a mortgage broker doesn't cost you anything, right?
No, so there are fees if you work with alternative or private lenders, but if you're with conventional lenders, we're paid by the lender. So there's no fee to you, there's no cost to you. So why not use a mortgage broker? I mean, the way that Fred and I work is we work as consultants. So we've brokered thousands of deals. So we have the experience to know what to do and where to take you to get the best deal.
Yep. And not just always getting the best interest rate, right? Because there's so much more. The terms, the conditions. This is very
You've been
important.
spending way too much time with Fred.
I know. I know. You guys are turning me into a mini mortgage broker at this point.
Yeah. Well, usually what I could say on that, Robin, is people make the first mistake when they're strictly looking for the best interest rate because it's often attached to a bad loan condition. Not all the time, but I think a mortgage, it's a combination of a product that suits your needs, has a good interest rate, and see your situation. It's basically why would you sign a 5 years fixed rate mortgage rate if you're planning to sell your house in 2 years? Like all kinds of things that we want to make sure that you're not making that mistake. Like we, as a mortgage broker, we try to get you the best product that suits your needs.
So let's say you already own your own home, but your mortgage is coming up for renewal. Should you stick with your current lender? You're going to get something in the mail from them with outlining the new terms for your new mortgage. Or should you shop around for a better rate? Are you going to get in trouble if you are with a lender for, talking to a mortgage broker and just seeing what your options are?
Well, ask yourself, how loyal is your bank towards you? And do you need to be loyal towards your bank? At the end of the day, a bank is there to make money for its stakeholders. It's not necessarily there to offer you the best rate under the best conditions. You need to push lenders, and that's what Fred and I do. So is it tempting to stay with your lender? Yeah, it's convenient. And it often, you don't need to requalify as long as you have been a good client up to that point. Some lenders will offer you a little perk or maybe waive some fees, but renewal offers are rarely the most competitive. They're not going to offer you the best rate they can at a renewal because they're going to count on you being lazy and just sign the renewal offer that you receive in the mail. So why not shop around? Why not give us a call? Why not, we have access to over 30 lenders right now. And why not allow us to analyze your file and analyze your financial situation and shop your mortgage around? Worst thing that can happen is you say, guys, Thank you very much, but I'm going to stay with my lender. But what have you got to lose by talking to us? We might find a better strategy for you. We might find a better lender with better conditions and at no cost to you as long as it's a conventional loan.
Did you have something you wanted to add?
Yeah, we just would have had it. It's so true. Like people usually sometimes takes their early renewal or the renewal offer from the bank and you just sign it. But I'll give you a best example. One of our clients signed his mortgage 5 years ago during COVID and called us up last week and says, I got an offer, a renewal offer at 436. It's that good. I says, well, if you don't want to have any headache and you just want to be a little bit lazy and take it, yeah, but we could get much better than that. I says, I'm not going to, tell you for 5 basis points to start the whole process. But in this case, we have a difference of at least 30 basis point that we could get you. And at the end, it's going to make you save a lot of interest, which is, it is the right thing to see different option. And it's like doing your due diligence. Why just taking your renewal from your bank? As Martin says, loyalty, it's a special, there's not too much loyalty, which is why should you be loyal to your bank? At the end of the day, you have to see your interest first. And sometime having a new mortgage with better condition and better interest rate uh, should be good for you.
Let me just add one thing too. At time of renewal, you need to ask yourself, should I just renew or should I refinance?
Hmm.
Because this is an opportune time to address those bad debts that you're carrying, those high interest credit card debts, those lines of credit, those HELOCs. This could be the opportune time to refinance as opposed to just renew.
So if you're refinancing, then you do have to requalify. So you kind of have to go through the process again, depending on the amount. So I'm going through this process right now with you guys where we're refinancing. And it kind of leads us, our next question was about self-employment. I'm also self-employed. So this is kind of everything all tied into one. How much harder is it to qualify for a mortgage when you're self-employed? And is it easier to refinance versus qualifying for a new mortgage?
It's definitely possible, but it usually requires a little bit more preparation, a little bit more paperwork. Most entrepreneurs don't declare a lot of income, and that's where the challenge is because most entrepreneurs don't want to pay huge amounts in tax. But by not declaring a large amount of income, it makes the qualification process a little bit more difficult, a little bit more challenging. But there is a workaround. There are different ways of qualifying a self-employed individual. And many lenders will ask you for things like 2 years of your tax returns, notice of assessments, financial statements, bank records to show that your business has stable income, which will support your mortgage application. So let's say the criteria of the banks doesn't fit your file. Well, then Fred just mentioned it. There are alternative lenders that could be a little bit more flexible, but alternative lenders do charge fees and the interest rate is a little bit higher. So you can't really double dip. So you can't really expect to declare low income not to pay tax and then also walk into a bank and get a conventional mortgage sometimes because you can't win on both sides of the ledger. So sometimes you may have to go to an alternative lender or you'll pay a little bit more, but just think of all the money you're saving by not declaring a huge income as a self-employed individual. One offsets the other. So there is a way to qualify self-employed individuals. And if there's one guy who can do it in this city, it's Fred.
Absolutely. No one else I would trust.
Uh,
If you're not sure if now's the right time to buy your first home, give LJ Realties a call at 514-500-4040. LJ will be back with us next week, by the way, and he'll have lots of information and lots of goodies for you, and he can always help you decide if now is the right time. Coming up, what is the stress test and how does it work? We'll find out after the news. This is Under One Roof MTL on CJ 8800. I'm Robin Flynn. That's Fred Pichette and Martin Spalding of Fred and Martin Mortgages. We are speaking now about the stress test. So when you apply for a mortgage or when you are trying to renew and refinance, you have to pass something called the stress test, which sounds very, very scary because nobody likes stress. But what actually is the stress test and how does it work? So at renewal, when you're in Quebec, do you have to pass the stress test, Fred?
Well, first of all, the stress test is you need to qualify on your contract rate plus 2%, meaning you're not going to get a rate of the contractual rate plus 2%, but that's the qualification rate that you need to use. And obviously, to answer your question, Robin, you do not have to pass the stress test if you just renew with your bank. It's you already did it 5 years ago or 10 years ago, and you're just taking a renewal. You don't have to do it. But again, as Martin says before, you may not have the best interest rate offer for your renewal. Worded sometimes to see if you could qualify with the stress test. Again, to see if you could get a better option somewhere else or paying your debt. Like the stress test is something we call GDS and TDS, gross debt service and total debt service. You basically need to qualify based on your income and debts on a higher qualification rate, which is just an example. If the interest rate right now is 4%, but you need to qualify on 6 interest rate. Like that's what we call the stress test.
But there is a bottom, there is a floor to it. So let's say you sign for 1.75% during COVID, you still had to qualify at the baseline rate of 5.25%. So it's the higher of the two. So if you're re-signing currently at 4%, the stress test brings you up to a qualification rate of 6%. But if interest rates fall into the twos, and 2 plus 2 is 4, they'll still force you to qualify at 5.25%. And that's, they say, to protect you, but it's also to protect the lenders. So if interest rates take off like they did a couple of years ago after COVID, you still have the wiggle room to make your monthly mortgage payments.
Now, question for you. I understand the purpose of the stress test is to make sure that if interest rates shift, you can still afford your monthly payments. Why do you still need to qualify for the stress test for a fixed rate mortgage? I understand for a variable rate mortgage, but it doesn't make sense to me for a fixed rate because your rate isn't changing monthly.
Yeah, it's a good question. That's something we keep saying that one of the rule could be changed. But why? Because what you say, Robbins, makes sense. If your payment won't change or won't budge for the next 5 years at 4.25, why do I have to qualify on 6.25? But again, that's the rules in place. As Martin says, it's really to technically to protect you and protecting the bank as well. But obviously, if your payment will remains the same, yes, you should not qualify on that. According to me, I agree.
I think the nuance there is that the stress test is really meant for when you're purchasing a home or you're refinancing. If you're just renewing, I agree. I don't think that anyone should go through the stress test, and they don't make you go through the stress test. But when you refinance or you're buying a home, it's like starting anew. You're starting a brand new mortgage. So that brand new mortgage, you need to qualify for it.
Okay.
But in 5 years from now, if you just want to renew with your current lender, so let's say you stress test, you get your refinance or you get your mortgage to purchase your home. In 5 years from now, when your mortgage comes to maturity, they should not put you through another stress test. But as I mentioned, when you buy a home or you're refinancing, it's like you're resetting, you're starting anew.
Yeah, but you don't have to be worried too much. Let's say your mortgage balance is 300 or 350,000. Your mortgage come up for renewal, and you're both working at I don't know 75, 80,000. You should be okay. Like even though we have the stress test, it's really it affecting a lot the first time home buyers, as Martin says, because if the price for property increase every year, it's kind of hard to qualify with that stress test.
So, how does the stress test change your maximum purchase price or refinance amount? Because if you have to qualify at a higher percentage, presumably that means your purchasing power goes down, right?
It does. So the lenders calculate what you can afford based on the stress test. Because the stress test rate is higher, your minimum loan amount shrinks versus what you can afford at the contracted rate. So, a simple rule of thumb, for every 1% in the qualifying rate can cut your borrowing power by 8 to 10%.
Wow.
But there are workarounds. I mean, Fred alluded to some of them earlier. What you can do is, because what you have to do is there are two ratios, there's GDS and TDS. So GDS is gross debt service. That has to do with everything that has to do with the house. And then total debt service is everything that has to do with the house plus your monthly obligations, car payment, loan payment, student loan payment, credit card payments. And the GDS has to be under 39% of your gross salary, and TDS has to be under 44%. So, whatever rate you're qualifying at, the higher the rate, the more pressure it puts on those two ratios. So, how do you circumvent that? Well, then you pay down your debt. Because if you get less monthly obligations, it puts less pressure on the TDS. You can often hear Fred say, stretch out your amortization. Because if it's amortized over a longer period of time, your monthly payments will go down. If you're really jammed up, you can always get a cosigner or a guarantor. If you can't quite qualify for the amount that you want, increase your down payment when it comes to a purchase. Shop lender to lender. The GDS and TDS are looked differently by certain lenders. And so when you're shopping around, you can perhaps find a lender that is a little bit more flexible when it comes to the GDS and TDS ratios. And also you can consider when you're looking at rates, an insured rate versus an uninsured rate. But when it's an insured rate, remember you got to factor in the insurance premium. So that's why you need to, and I hate to say it, but that's why you need to work with mortgage brokers because we know all the ins and outs of all these things. And a lot of people just take it, they'll accept whatever a lender says to them verbatim when, there is strategy when it comes to mortgages and mortgage rates and how to build a file so that it qualifies. And that's where a guy like Fred, who's done thousands of mortgages, has seen every scenario and knows how to address it and where to take it.
Well,
Absolutely. And sorry, go
I
ahead.
gotta say, Robin, Martin is pretty good too. Like, it's not only about me.
Well, and honestly, as somebody who's working with you guys right now, I can attest to how easy the process is. It's very easy to get you guys on a call. Your portal is fantastic, so it makes uploading documents very clear. It's very clear what is necessary and what you need. If you're organized, like I am, and I have easy access to anything you guys need, you just tell me what you need and I can upload it. It's so, so easy. So there's a huge benefit to working with you guys because you make the process so easy for your clients.
Well, I think the key that you just said, you got to be organized. When you get a T4 sent to you, put it in a file.
Mhm.
When you get your mortgage statement, put it in a file. When you get your municipal and school taxes, put it in a file and have those documents ready. Often we will call clients and we'll have sort of the introductory onboarding conversation with them. And we'll say, well, we need your T4s. And they'll say, what's a T4? What's a T1? Can I send you screenshots? It really becomes very laborious. So the more organized you are at home, and remember, your home is the greatest investment you will ever make. So why not just find that one little file? I'm not asking you to have 100 files, but your mortgage statement, your municipal school taxes, your T4s, find out where to get a letter of employment, where to find a pay stub if you have to download it for the company website. And all these things, the faster you can get us the documentation, the faster we can get you approved, the better quality the documents are, the easier it will be for the underwriter to approve your loan. So help us help you.
Exactly. That line from Jerry Maguire.
It's so true. Document is key. Like, it's something that we can't go.
No, because sometimes we'll get a mortgage statement. There's no number, there's no name. It could be a mortgage statement for any home in Montreal. So you send that to the underwriter, go, okay, whose mortgage is this? And for what address? Yeah, that's a good point.
Yeah, and being organized is key. Like the appraiser came this week to do the appraisal for our loan and he needed the certificate of location. Well, I'm organized. I knew exactly what file that was in. And then he had a question. He asked when our roof was done. I didn't know that off the top of my head, but we had an inspection done when we purchased the house. I had the inspection report saved on my computer, pulled it up, found out roof was done in 2017. Having all of this information easily accessible and knowing where it is just makes the process so much easier.
Well, it's just like the conversation we had with the notary last week, right? Where's your will? Where's your bank account? God forbid you get hit by a bus and then your wife is going, I don't know if he had a will. I don't know where his bank accounts are. I don't know if he's got any investments. Why would you do that to her?
Mhm. Not fair. Okay, to find out more about what your options are, if you want to know if you need to pass the stress test, you've got a renewal, maybe you're a first time home buyer, get in touch with Fred and Martin. They are fantastic at what they do. Go to their website at fredandmartin.com. Coming up, we have the answer to our trivia question of the week. What is the difference between a variable rate mortgage and a fixed rate mortgage? We were literally just talking about it. 514 790 0800. The answer is coming up after we check traffic. Robin, that is Fred, that is Martin. You are listening to Under One Roof MTL on CJD 800. Before we get to the answer for our trivia question of the week, I wanted to ask you guys a question about pre approvals because there is so much misinformation out there about pre qualifications, which are those silly little online surveys you can take and get an answer in 2 seconds, versus a true pre approval, which requires documents. How long does a pre approval last? Let's say I come to you, Fred and Martin, and I get a pre approval, and now I'm ready to go to LJ and start house shopping. How long do I have to find a property and put in an offer before my pre approval expires, or does it expire?
Well, I love to say a pre-approval is good as long as you have the same situation. If we pre-qualify you for 600,000 based on a certain salary, down payment, and a credit check, pre-approval is good. But if we want to reserve a rate for you, usually it's good for 120 days. After that 120 days period, we just have to resubmit it again and just asking for an extension for another 120 days. But most lenders out there will lock you in a rate for 120 days. Some people would say, oh, I got one for 180. Yes, it's possible. But more or less, the average in the industry is 100 for 120 days.
So here's some advice. So you get pre-approved and your rate is good for 90, 120 days based on the financial situation when we did the pre-approval. So during that period, don't go out and lease a car for $100,000 where you're going to be paying $2,000 a month because that will change the ratios. During those 90 to 120 days, don't change jobs. It's all about stability because we based the pre-approval on your financial situation at the time that you were approved. So if your financial situation changes, the pre-approval letter will go out the window. And often we'll put in our letters based on the information we had at pre-approval time. But if that situation changes, you got to let us know. Because we've had situations where people have gotten an accepted offer based on a pre-approval, but they forgot to tell us, oh, by the way, I went out and bought a $95,000 pickup and it's costing me $1,800 a month. Boom, the ratios go completely out of whack. And then there's no guarantee that that the pre-approval or the approval will get through the lender's due diligence. Or we had we had we had this gentleman that called us up. We pre-approved him. Terrific job, fantastic. And all of a sudden he calls us up. He goes, "Oh, by the way, I got another offer. I'm going to work somewhere else." No, 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 no. Wait until you go to the notary and sign for your home before you announce to anybody that you're leaving your current job and taking on another job. Stability is the key through all this.
Yeah, and the reason, Martin, for that, it's most of the job has a 3 months probation period.
Exactly. So in other words, you can lose your job within those 3 months if you don't live up to what you said during your interview.
So once you're
Sometimes we could get it done, but most of the time we have to wait that 90 days probation period.
So once you're pre-approved, you find your property, get an accepted offer, are they going to do anything again? Like, are they going to run your credit again to make sure it's the same as it was? Or, what happens once the offer is accepted with your pre-approval?
Well, of course, if we did a pre-approval 90 days ago, at the time that you coming to us with an accepted offer, obviously we need updated documents like pay stub and letter of employment and an updated credit check. And that's why Martin was saying that it's important that you keep your debt as the same level that it was 120 days ago or 90 days ago. Like, yes, they will do another credit check, but obviously, if everything remains the same, you should not have any issue. And one thing I could add to this is it's so important when you do a pre-approval to send us the documents. Why? Because our pre-approval is based on documents. Without documents, to be quite honest, it doesn't mean much. I believe in people. I'm a very optimist guy, but again, when someone says I make 100 grand a year, well, we need to have the pay stub showing that you're on a pace of 100,000 a year, not on 80,000 a year. And by asking for the document for the pre-approval, we avoiding any problems down the road.
Yeah, I mean, transparency with us is critical because we can only work with the information that you give us. So the more accurate the information you give us, the better we can pre-qualify you and give you a letter of pre-approval. But if we find out that you did a consumer proposal, you went bankrupt, or you went out and bought a $100,000 car, you got to tell us these things because we can work with the truth, but we can't work in the shadows, as they say.
Absolutely. Okay, let's get to the answer to our trivia question of the week brought to you by Felix and Norton. Our question this week was, what is the difference between a variable rate mortgage and a fixed rate mortgage? Basically, a fixed rate mortgage has an interest rate that remains the same for the entire duration of your term, which makes your payments predictable. While a variable rate mortgage, that interest rate fluctuates with the market. So whatever the Bank of Canada decides, that's what your interest rate, how your interest rate will be impacted. So your payments can increase or decrease each month depending on that. Am I right, guys?
Yes, you're absolutely right. But you could have a variable mortgage, which is they will not adjust the payment, even though if the Bank of Canada cut their overnight rate, the prime rate. The only difference is you're going to pay a higher portion towards the principal than the interest. But normally, I would say most of the bank will adjust their payment. We call that an adjustable variable rate.
Perfect. So our winner for this week is Sofiane in Nuns Island. So check your messages so we can get your info. That's pretty much it for us for this week. If you ever have a question for us, you can always text in 514-790-0800, or you can email your questions to info@underoneroofmtl.com. In the meantime, you can get in touch with Fred and Martin individually, as well as LJ, who I said will be back next week. Check out his website, by the way, ljrealties.com, or follow him on social media at LJ Aguinag. Fred, Martin, where do people go to get in touch with you?
So, first time home buyers looking to renew, looking to refinance, looking for a reverse mortgage, easy to find us, fredmartin.com, fredmartin.com.
If you missed anything, you can listen to this show in its entirety on the iHeartRadio app, Spotify, Apple, or wherever you get your podcasts. For LJ, Fred, and Martin, I'm Robin. Have a wonderful Sunday.